The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and we're here to give you the very best up-to-date news on what's happening in Congress because it affects your taxes, it affects your bottom line, it affects your finances. And I'm joined in studio with Christopher Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher. You know, I was watching Seinfeld the other day, and that's what he always did. Seinfeld always did to Newman.
Hello,
He'd go, hello, Newman.
Yes.
So am I Newman to you, Chris?
No, you are not Newman to me. I may be Kramer to you, but...
No, you don't slide in like that. And anyway, and I got Tiffany Fabian. Hey, Tiff.
Hey there, Esther.
Okay, so we're going to talk about health care. We're going to talk about the Excelsior scholarship. We're going to talk about getting ready for college. And this time of year, you know, we're going to always be dealing with the tax aspect. But as things change in Congress, and we're looking at some potential large changes, we want to make sure that you know now before everybody else, so that you can plan, so that you can really be ahead of the curve, right?
That's right. Absolutely.
Okay, so again, and our phone number here in studio is 803-0930, 803-0930, star 930 on a cell phone. And really, there's no subject that's off limits if it has to do with money or questions or taxes or bills or you haven't filed or anything. So you don't have to limit your calls to what we're talking about today,
You know,
with the health care and Excelsior. But you know, we invite all callers, 803-0930, 803-0930, star 930 on the cell phone. I stepped on you, Tiff.
yeah, you know what I was going to say? I'll often throughout the week when we're at the tax office, people will be doing their tax returns still this time of year, and they're like, yes, I know we're going to talk about the Excelsior College Credit Scholarship, and they're like, yay, my income is below $100,000, and I know you're going to talk about it later, but it's based upon that 2016 filing. So these 15. Are questions.
Well, actually, that's part of what we want to
talk about today.
Is that the Excelsior? Well, actually, first let me do the health care, then we'll go to Excelsior. Okay.
Yep.
For health care, what they're proposing now, the first thing I have to tell everybody is don't get nuts. It only passed the House.
Right.
I mean, it's got to go to the Senate, and if you think the House was nasty, wait till they get to the Senate. So, but this is what the health care bill is proposing right now. It ends penalties. Okay, so we know under Obamacare that if you didn't have health insurance for at least 9 consecutive months, there was a penalty that was assessed. That was 2.5% of your adjusted gross income, or your actually modified adjusted gross income, right?
Yep.
So now that penalty, if this goes through, will be waived. And so those of you that are younger or people that just couldn't afford it, if this goes through, you're not going to have that penalty. So that's the first thing. And the other thing is, what we want to do here is we want to talk about this dispassionately. I don't want people thinking, oh my gosh, if this gets passed, that means that, we're going to hell in a handbasket. I mean, you have to understand, Obamacare was really failing. We're actually very lucky to live in New York State, because the state of New York has kind of developed its own Iron Shield healthcare, the New York State of Health. And so many other people in the other 49 states are not receiving the benefits that New Yorkers get.
Correct.
Correct?
Like the Medicaid and all the
Right.
benefits
And
that
so
go around
New York
with it.
State is very much a more socialistic form of government. And so, just like now with the Excelsior program, it's the first state in the union that's going to offer free scholarships or partial scholarships to people that go to public, and something for private schools as well. So, but I guess in order for you to know something, the Bible says the truth will set you free. So we're going to try to give you the truth. Okay, so the first thing is the penalty ends for health care. The second thing, it ends the tax increase on higher income people. There was a tax increase that people that were upper income that had to pay. What was it, 2.9%, Chris?
3.9%.
3.9%.
And 0.9% on capital gains on investment income.
So that is another thing that's ending. It also cuts the Medicaid program and lets states that want to impose a work requirement. So, that just sounds so mean-spirited, but the bottom line is people that are on Medicaid are not necessarily working. And so what it did is it gives states the opportunity to say, if you want free health insurance because of Medicaid, we think you should work. Now, maybe that upsets people. It doesn't upset me. See, like, I have to work. I believe in working, and I hope a lot of people believe in working. Now, obviously, if you can't work, that's a horse of a different color, if you're truly disabled. But these are able-bodied people that are collecting free health insurance, and this bill would allow the states to impose a work requirement. Now, I don't think New York will be one of those. I don't know what you guys think, but I don't think New York will be one of those. But it does give other states that opportunity.
Yeah, you mentioned that New York is more of a socialistic state, and so I agree with you.
Right.
Okay.
The other thing is the tax credit. There's not going to be any subsidies anymore for tax for like those of you that are on the New York State of Health. There's not going to be any subsidies anymore. There's going to be tax credits. So when you come in to get your taxes done, if you're a younger person, you could get a credit up to $2,000. If you're over 60, you could get a credit up to $4,000 for paying for your health insurance. Okay. Now here's the thing. If you notice that the people over 60 get a larger credit because under this bill, states have the right to charge seniors more. They can ask for a waiver to charge more to seniors. Well, which only makes sense to me because, let's face it, seniors, as you get older, your body falls apart.
Right.
New knees, new
costly.
hips, new elbows, new joints, all that kind of stuff.
But they're the ones who are.
But they're on a fixed income,
Right.
and that's the rub.
Right.
Right?
I agree.
And that's what's that's where it'll be interesting to see how they reconcile this in the Senate. But I'm just telling you what it says, right?
Yeah, but Mike, I agree with what you said. The rub part, they're on a fixed income.
I knew when they tackled this was not going to be easy because there are so many moving parts to this.
Yep.
The other thing is no Planned Parenthood subsidies in this bill. The age 26 for staying on your parents' health insurance stays.
That's good.
Let's see. And the other thing is you don't have to buy health insurance through the marketplace. So, whereas under Obamacare, if you didn't have employer-sponsored health insurance, you had no option but to go to the marketplace without getting the penalty.
Okay.
Right?
So now you could get it you could just
Outside
knock on the
the
door.
Back
and go.
through the Chamber of Commerce.
That's
back through-
exactly right. Which would encourage, I think that what they're thinking about is that it would encourage competition. And competition
right.
usually
It's
lowers
good.
prices. So I thought those were the highlights of the bill, and I thought it would be important to talk about it without people saying, oh, you want to push grandma over the cliff and everything. And, let's face it, I'm an old dude. So I can understand where they say that they wanted to charge more for seniors, but unfortunately, seniors on a fixed income just can't afford anymore. So somebody's got to be creative in this end, it would seem to me.
Yep.
Right? Anyway, I'm Esther Goulias, the tax lady from EG Tax, joined in studio with Chris Fabian, Tiffany Fabian. We would love to hear what you have to say. 803-0930, 803-0930, star 930 on a cell phone. We got your calls on the other side, and we'll be back with the health care bill and the Excelsior program, and we're going to give you the scoop. See you on the other side.
As you say, that's happy music, right, E.G.?
That is, let's see, is that, I was waiting to hear who sings. Is that the Michael Jackson?
Jackson
people?
5.
Jackson 5?
Frank said yes.
Yes, see, my God, that harkened me back to the 70s or something. But anyway, I'm Esther Golias, the tax lady from EG Tax. You know that commercial that we just played with you talking about making a decision financially based upon old tax law. If you're going to do something substantial this year, make sure you give us a call before you do it, because the tax laws are going to change. I think it would be well for you to sit back and wait and see what happens so that you know how the change in the tax law would affect you. It would be a terrible thing for you to take money out of your 401k, for instance, right now at 25%. In January, it would have been 10 or 15%. I mean, you know what I'm saying? Yeah. It would be, you'd be shooting yourself in the foot. So that's why you want to make sure, with all this substantial tax law looming, it's okay to just sit back and relax and see what's going to happen. But at least call EG Tax. We don't charge you to talk to you. And you can visit us online at egtax.com and ask the tax lady, and actually the message comes right to me and I answer it. You know,
yeah.
I may be floating in my pool, but I will. Of course, you can't float in a pool in 41 degrees.
We've been lots of letters from the IRS lately. I just had a person yesterday who had a letter that he owes $4,000 to the IRS. But then we got to talking more, and he said, I'm under the age of 59. I know I didn't put the pension on. But then he told me it was from a Roth, and I was like, aha. Because the truth is, if you had that Roth for the last 2 out of 5 years, it's only the gain that's potentially taxable. So he came in right away, and he was a happy camper.
And the penalty, too. If you're under the age of 59 and a half and you have a Roth, the money that you put in and you take out is not going to be taxed, but any increase is going to be taxed plus a 10% penalty. But usually it's not much money.
Yeah, but
right?
Of course the IRS will tell you the worst story.
Right,
you know?
Right, because they don't know. They don't.
Right.
Of course, the code probably did say Q
J or T.
Or J or whatever it was. Anyway, let's, I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. And we've had John from Cheektowaga, who's been so patient. John, how can we help you?
Good morning.
Hey, I think it's afternoon.
Well,
are you like in Australia, John?
Or maybe he works the third shift or something.
Well, a 401, because since I have a 401k that will be starting, that I'll be eligible through my employer. But however, because we have a profit sharing as well, and that's where the employer does most of the matching and contributing to. Is this good? Is this bad? Should I look into a separate 401k? Because my fear is I'm 9 years older than my wife, so the inevitability of me passing before my wife is great.
Okay, but here's the thing. The federal government loves spouses. So whatever you would have in your pension program, upon your death, if your wife is the beneficiary, which I'm assuming you would make her the beneficiary, is going to pass right to her. She can put it, she can leave it in the company or roll it over into an IRA, and it's not going to be taxable to her. The whole thing is, your game plan should be that you want to set aside as much money as possible for your retirement and or your death, if you want to leave it to your loved ones. And so a 401k is a wonderful vehicle to use. Would you guys agree with that?
Absolutely. And very good vehicle. And the nice thing is that you want to find out what your company will match, and it's a great vehicle. And then if you're a lower income person, you get the retirement savers credit. It lowers your income that's taxable on your return. It's a great plan.
All right. So John, you said you're under 59 and a half, right?
Yeah, I'm 36.
All right. So you can put up to $18,000 in your 401k. Okay, and your employer can do 1, 2, or 3% match of of your wages. So if your wages are $50,000 and they're doing a 3% match, they're going to add another $1,500 to the pot. So now you're up to $19,500. But if you put in the whole 18, not many people could, but I'm giving you the maximum. But let's just say that you put in 5 into your 401k, and the employer does a $1,500 match because the 3%. You'd have $6,500 in there versus $5,000. I'll take 65 over 5,000 any day. I mean, wouldn't you?
Oh, absolutely.
So, I mean, I would load up that pension as much as possible and make sure you list your wife as a beneficiary so that it'll pass right to you, and hopefully you guys have a long life together.
Awesome. And then if there's a chance, maybe I could give you my phone number because I've been going to EG Tax for 4 years, and and I love them. You guys' prices is by far competitive to some rival ones, but this year we did have a substantial issue that I'd really like to see get rectified.
Hey,
Yeah.
no problem.
Give
you
me-
know what we
Jen-
can do? We'll put you on hold, and then we'll take the number, and we'll make sure we call you in between the break, okay?
I'll call you on Monday. Is that okay, John, or on the break, whatever you prefer?
Okay, but we'll make sure we get to it, all right?
It's something that I'd really would like to get rectified as soon as
We will.
We will right away.
Okay. Jay, get
John?
his number.
All right. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we have Tony from Clarence on line, too. Hey, Tony, how can we help you, sir?
Good afternoon to everybody.
Hey, Tony.
Hey there, Tony. How you doing?
Well, I've had some illness in the past months, but I don't want to dwell on that.
Well, I hope you're feeling better.
In 1963, President Johnson signed into federal law Medicare and Medicaid. This new bill that's being proposed that passed by one vote in the Congress, $830 billion are being taken out of Medicaid. 830.
All right. Are you aware, Tony, and I know you love to get political, and I really don't like it. I'll tell you, bottom line.
Not being
All
political.
right, but wait, yes, Tony, you are always political. You are a Democrat, and you're going to talk just like all the Democrats, and you're going to be mad. And the reason they're taking money out of Medicaid is there's so many people that are getting Medicaid that aren't working, and so they're now giving the opportunity to the states to require that somebody that's on Medicaid, not Medicare, Medicaid, that means it's a full boat ride because of your income, okay? And so that's what they're doing, is they're trying to make it so that it works for everyone. Right now, Obamacare is not working. And if we don't change what we're doing, we're going to continue to get what you got. And I thank you for calling, Tony. Okay. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. That's the trouble with our government. We want everything to change, but we don't want to change everything. And so this is a problem, and so hopefully there's going to be a solution. But Medicaid has been a very, very expensive thing. Just look at your tax bill in New York State, your property tax bill.
Yep. And one thing, going back to John's phone call about his 401k, should he put money in because he thinks he's going to pass away first? One thing with listing his wife as the beneficiary is it rolls right into her IRA, and she doesn't have to start taking it out to 70 and a half. So heaven forbid something happens to him tomorrow. That money would still be there 40 years from now for her. She doesn't have to touch it, where if it goes to his children or somebody else, they have three options: taking it all out at once, taking it out over 5 years, or start annuitizing it over the rest of their life.
That's true. But here's the thing, he's 36.
Right.
He's 36.
Got a long
My
time.
assumption is he's going to be around
Hopefully.
for 50 or 60 more years.
Hopefully.
But here's the thing that I loved about John was that he's planning ahead and thinking ahead.
That's right.
And you want to make sure that you understand that there is, the decisions you make today affect tomorrow, which brings me to Tony. And when we have to modify something here in order for our civilization to go forward. So you can't say, oh, this is terrible, 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 terrible. We have no money, but we're not going to change anything. Something has to happen. And people that aren't working, that are getting all the freebies, free education, free health insurance, and people that are working have no idea about how much freebies are out there. I mean, it is true. Would you guys not agree?
Oh, definitely. I mean, I think we ran numbers where if someone who makes $15,000, who has like 3 kids, lives like they're making $85,000 because of all
everything's free.
Right,
The
and the
education's
person.
free, the health insurance is free. The rent gets subsidized. They don't pay any income taxes. They get earned income credits from the state and the federal of like $18,000, all tax free. And so here you have this other couple that are killing themselves, making $60,000. They have to pay for their health insurance. They're paying income tax, and so what happens is everything gets so emotional. Everybody's screaming at each other, and nobody listens.
Yep.
Yeah, and I think you said a really good point, is that it touches upon Medicaid, not Medicare.
It's not
which is-
Medicare. I
Right.
mean, it's not It's Medicare, Medicaid, not Medicaid. Care.
Right.
There
That's
is
what I said.
a vast difference between the two. Medicare is for people that are over 65 and are retired and all that, or disabled. Medicaid is for people that do not have the money for whatever reason to pay for their things. So they could be working under the table, they could be doing drugs, selling drugs, they could be whatever. That's not somebody on Medicare, that's somebody on Medicaid. And it's an issue that has to be addressed, in my opinion. Hey, let's go to, do you think we got time for Ray from Boston?
We
Or
got a
should
minute. Do you want
we got a minute. I don't want to, but Ray, don't hang up. 8030930, 8030930, star 930 on the cell phone. And what we're going to talk about on the other side of the news is we're going to talk about the Excelsior Scholarship from New York State, because we want to give you the facts on that. And when you dig into the facts, you find out that it really isn't as lucrative as it sounds. And that's what facts give you. Facts takes the emotion out of it and really just gives you the hardcore numbers to look at. But we're going to help you guys so that you're ready. If you have kids let's say you've got kids that are sophomores right now or juniors, we're going to give you information so that if your income right now is 100,000 or less, 110,000, some tools so that you can take full advantage as much as possible with the Excelsior program. Again, 8030930, 8030930, star 930 on your cell phone. I'm Esther Gulia. See you on the other side of the news. Okay, who's that? That's somebody old.
Hall and
That-
Oates.
Who is that?
Hall and Oates.
Hall and
Rich
Oates.
girl.
I knew the
She's
song.
a
I
rich
just didn't
girl.
know- I didn't know who.
Who sang
Didn't
it?
know who was singing it. Anyway, I'm Esther Gulius, the tax lady. 8030930, 8030930, star 930 on your cell phone. Okay, so we kind of beat the old healthcare thing to death. Not really. There's a lot that's going to go on, but as it unfolds, we will let you know. Okay, and during the week, if you have questions, just give us a call at our corporate headquarters at 632-7886, and we'll be happy to talk to you. Let us go to Ray, who has been waiting from Boston. Hey, Ray, how can we help you?
Good afternoon, Esther. Do we need to worry about the Cadillac tax?
No, it's going to be set aside. I mean, okay, right now, it is nothing. It's just a bill.
Okay.
And it's got to go to the House. I mean, it's going to go from the House to the Senate, and the Senate has to reconcile their version with the House version. So we're way far out.
Okay.
We're way far out from anything being passed.
Thank you much.
And so, but that's why you can't really glean anything substantial until everything's all nailed down. That's why I want to give everybody what's in the bill now, so that you have an opportunity to talk to your congressman. Well, actually, it's your senator, because it's going over to the Senate now, and say, oh, I like this, I don't like that. But if you're so emotional, this is so sad what's happening in the United States. It's an emotional roller coaster. But yeah, Cadillac tax is supposed to be set aside. All the penalty provisions in Obamacare are supposed to go away.
Good.
And I really think that's what's going to happen ultimately. Okay?
And thank you very much.
Well, thank you for calling. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. I think I heard you breathe, Chris.
You did. Wasn't the Cadillac tax, though, postponed to 2020 anyways?
Yeah, they were backing it up
and kept backing it up. So
backing it up. Yep. So.
Hey, as long as it has a reverse cam, we're good, right?
That's right. That's exactly right. Okay, let's talk about the Excelsior Scholarship. I know a lot of people that have children in high school are wondering about how is this going to help me, et cetera, et cetera. Well, we're just going to talk about the facts. First of all, you have to be a New York State resident, number one. Number two, you have to have adjusted gross income based upon your 2015 tax return when you're doing your FAFSA application, all right? Under $100,000 for 2017. So you're basing it upon your income from 2015 in order to qualify for the Excelsior Scholarship for 2017. So there is no planning we can do on this. It's set in stone.
That's right.
Yep.
I mean, all right. Then next year in 2016, they're going to base it moves up to 110,000, and they're going to use the 2016.
Yep. For 2018, they're using
2018.
Yep.
Now, so that would mean the only return that you can really affect is for 2019. Because they're going to use the 2017 tax return that hasn't been done. So let's say you got a kid that's a sophomore right now, or even if it's a junior, they can start off not qualifying for the Excelsior program because maybe your income's $106,000 this year, but or in the year that they go in 2017. But you have an opportunity to knock down that income using some tax strategy so that you would qualify.
Right. Like we were talking with John, load up your 401k.
Right.
If you don't have a pension, use an IRA. How about an HSA?
Flex spending, yeah.
You know, your flexible spending accounts. You can use them to your advantage.
Right. So I'm doing three things at once.
Not you. You should be doing 5 things at once.
I like to multitask. But the whole thing is, and the only way you can make that decision is for you to take a look at, what are the benefits of the Excelsior Scholarship and how much am I willing to put away into my 401k plan. And the 401k plan obviously is the easiest thing to do. You would not quit your job. But let me give you an example. For instance, with the Excelsior Scholarship, this is a maximum scholarship. I got all this stuff here. This is after TAP and Pell. So you apply for you do your FAFSA form and you get your TAP and Pell, okay? And then minus that, then you can you would get the Excelsior Scholarship, and it's for New York State colleges, public colleges, and it also applies to private colleges. I was not aware of that.
I didn't know that either.
Right. So who can receive the Excelsior Scholarship? An Excelsior Scholarship recipient can receive up to $5,500, all right, minus any awards from TAP and Pell, all right? And the remainder of your tuition charge will be covered through a tuition credit paid by SUNY and CUNY. Also, if you are going to a private college, it's up to $6,000, I believe. Let's see.
Tuition.
If you're going to a private, not-for-profit college, then you get an award up to, where am I at here? Public college. Transfer student scholarship, associate's degree, it's in here. Enhanced tuition awards. For New York State students attending private not-for-profit colleges in New York State, up to a $6,000 through a combination of TAP and enhanced tuition award and match from the private college. So this is called the Enhanced Tuition Award. That's also on the Excelsior website. So if you're interested in getting more information, you can kind of Google Excelsior Scholarship, and there is a complete 4-page thing you can print out and take a look at it and how it affects you. But you can see that they're going to reduce the award by TAP and Pell. So it's a wonderful thing as far as the $5,000 goes, but it isn't what many people think that it was.
No,
and I'm glad to see that it includes private colleges, because we were all concerned about those private colleges if this was comes to
Well, I
fruition,
think they threw
it's
the
going to
private
trample.
they threw a bone to the private
Yep,
colleges,
yep,
right?
yep.
But obviously this is for, you can be in a 2-year program or 4-year program. Then the other thing is you have to live in New York State. If you got a 2-year degree, you have to live in New York State for 2 years after graduation. Otherwise, what they gave you turns into a loan.
Yep.
Yeah,
So
which I heard earlier today, it turns into an interest-free student loan. So that's going to be very interesting to see how that really falls out, if that's true or not.
You mean in the event that they don't live in New York
Yeah,
State?
if they move from Buffalo to L.A. and they had $20,000 through this scholarship, they would have to pay back the $20,000 interest-free.
So that right now the tuition in New York State averages for state of New York colleges $64.70, and for community colleges $43.66. Okay, in Western New York there are 68,712 families that qualify using the $100,000 adjusted gross income criteria, and you can actually, I think you can start applying right now. Because you're using the 2015 tax return for the FAFSA form. So the earlier you apply, the sooner you'd get in. They're anticipating like 200,000 new students coming to the state, coming into the state schools because of this program.
Wow.
Well, hopefully they have the seats and the capacity and the teachers to handle the increase.
Right. Anyway, I'm Esther Gulius, the tax lady, 8030930. 8030930, star 930 on a cell phone. So what if you're making $120,000 a year right now, and you anticipate by the time your kid goes to college you're at 130, and you know that the maximum is 125,000? What can you do? Well, if you're not using your 401k plan, you can put, if you're under the age of 50, you can put $18,000 away. That would drop your income then from 130 down to 112,000. So then your kid would end up could go to school with over $5,000 if they're
And a
a Tap and
scholarship.
Pell. From the Excelsior Scholarship. So that's where you want to plan. And if you're not sure what to do, you can give EG Tax a call, because we'll help you to plan and show you different things that you can do. And Chris, you mentioned putting money, if you have a high deductible plan, into an HSA.
Right. HSAs, maybe if you have younger children who are still in child care too, you can use your dependent care benefits. Use all the tools that your employer gives you to your advantage to bring down your income.
Maybe
Right.
get
And
a
then what
piece of
also
property.
is making, the other thing that's making this like an eggshell to walk on, we don't know really what's going to happen with the tax code. So right now we're talking about adjusted gross income based upon everything we know, based upon old law. But part of what they're proposing, and again it's just passed in the House, is that the standard deduction is going to increase substantially for a married couple, but the personal exemptions are going away.
Right.
So
I was just going to say, I'm sorry, I had someone in yesterday who's like, "Oh, this is great. I'm going to get $12,000 instead of $6,000, and I'm going to make all this extra money on my tax return." I said, "No, you're not." And he looked at me, he goes, "What do you mean?" I said, "You're losing your personal exemption.
Right.
So you're actually only gaining a $2,000 subtraction. So in 15%.
And the bottom line was at 10%, now it's at 15%.
Yeah.
So, that's why I think the important thing that you do is you look at everything dispassionately so that you can make an intelligent decision, and because you don't want to call your senator and start screaming and yelling. You want to find out logically what really they're proposing. So the increased standard deduction sounds really good, but if you had 3 children and a husband and wife, you would have gotten over $20,000 in personal exemptions.
Yep.
Right?
Yep.
That's right.
And you would have had let's say almost $13,000 standard deduction. So you would have had a $33,000 deduction. Now you get $24,000.
So you lose.
$8,000, right?
Yep.
So, all that glitters is not gold. Why don't we go talk to Don in North Tonawanda? Hey, Don, how can we help you?
Hello. I'm 78 years old,
Okay.
and I'm still working.
Okay.
I'm still contributing to a 401k.
Good for you.
and therefore I do not have to take the RMD yet.
Not
Correct.
on that, but on any non-work, let's say that you had 3 other pension plans prior to you working. Those plans you have to take the money out of. The one where you're working, you don't have to.
Right. Now, here's my question. I'm going to be stop working on July 30th, and I will stop contributing, of course, to the 401k on July 30th of this year. Do I need to take an RMD on that plan in 2017 income, or can I wait till 2018 income?
You got to do it on 2017.
Oh, my goodness. Okay, that's a good thing I asked.
Yeah, so you want to make sure that you get that RMD because it's at 70 and a half or in the year that you retire. So that would be this year. So you'd want to make sure you do your RMD. And again, your RMD is based upon your life expectancy. It's not as much money as people think, is it, you guys?
No. It starts off, the visor rate's 27.4.
If he would be 70.
If
but
he
now
would be
he's
70.
older,
Yep.
right.
I'm trying to figure out what that is right now.
So it's probably around 20. So do you know how much you have in your plan? Don?
Right, about 300,000. Right.
Okay, so you divide 20 into 300,000, and it looks like what, 12 or 13,000 a year you're going to have to start taking out. And each year it'll go up a little bit.
So I better plan for the additional taxes I'll have to pay.
Yes.
That's exactly right. Again, now, you don't have to pay those taxes in until you take out that RMD. So let's say you wait till December to do your RMD. By then, you'll see the tax law kind of fleshed out, and you'll know better how much to withhold. So
Don, are you collecting Social Security too?
Yes, I am.
Sure.
Okay. I wasn't sure if you waited a long time because you wanted to plan on that too.
Hey, let's take a break right now. I'm Esther Gullius, the tax lady. Thanks for calling, Don. 803-0930, 803-0930, star 930 on a cell phone. We're going to take a short break, and we'll be back on the other side with your questions.
It's been 1 week since you looked at me. Cocked your head to the side and said I'm angry. 5 days since you laughed at me.
Wow.
Together, come back and
Hey, man, this is Esther Gullius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on cell phone. Well, now, who are they? They were the whats?
Bare Naked Ladies.
Bare Naked Ladies.
Bare Naked Ladies.
Yes.
That's great.
And Esther, you were almost right on. It's 20.3 for the minimum distribution for
At his age.
At his age. And Tiff brought up Social Security. We now have a new tool on our website for people to see how much money or how long it would take to catch up to recoup all that money you lose by waiting to your 70 or 66 to collect Social Security.
Let's say that you could get $2,000 a month at age 62, just for simple math. That's $24,000 a year that you're giving up. If you waited the 6 years before you start collecting, you're giving up $144,000. Now, they don't. If you were to die a day after you started collecting, they don't come to your coffin and say, gee, we owe you $144,000. You lose the money. So that $144,000 has to be, to figure out how many years it takes for you to recoup that, you have to figure out how much more you're going to be getting in benefits. So if your benefits went up 20% so that you're getting an extra $4,000 a year, you'd have to divide 4,000 by the 144,000, and it comes up to be about 16 years that you have to live longer to break out even.
Right.
And so I was meeting with a client yesterday, and I said to him, aren't you going to be 62? And he said, yes. And I said, how come you're not collecting? And he says, well, I think my broker says I should wait. Now, it just so happens that this gentleman has cirrhosis of the liver, and he's having a liver transplant. Now, his longevity is dubious at best, So, I mean, you really have to look at your circumstances, number one, but number two, you have to really realize that at the end of the tunnel here, as the life expectancy gets less and less. So you're really doing a crapshoot. So yes, you'd get more money later, but will you be here later to get the money?
Right.
That's the question.
And I know like you said, most financial people will tell people to wait. But I did a tax return for a financial consultant this year, and that was her belief, to wait. And she talked to a lawyer from Social Security, and he told her that we laugh when we hear people talk about waiting to 70 or 66, we laugh because 95% of the time, Social Security wins.
Yep, that's true. And it's a crapshoot. Before we go on here, the Excelsior Scholarship covers full tuition for eligible State of New York and City of New York students, up to $5,500 minus TAP, Pell, and other awards. For fall of 2017, the eligible families have to have adjusted gross income of less than $100,000 based upon your 2015 tax return. Okay?
Yep.
There's an enhanced tuition award for New York State students attending private, non-for-profit colleges in New York State, up to $6,000 in combination with TAP. The Tuition Assistance Program in New York State has the largest grant program. It's up to $5,165 based upon a student's family's New York State taxable income. The New York State Part-Time Scholarship Award for kids that are going to school part-time, that don't do the 30 hours, is up to $1,500 per semester for the first 2 years of college. And by the way, all of the Excelsior scholarships are limited to 2 years if it's a 2-year program, 4 years if it's a 4-year program. That's the most that you're going to get any of those awards. Now, the New York State Get on Your Feet Loan Forgiveness Program provides up to 2 years, 24 months of federal student loan debt relief to recent New York State college graduates for New York students who attended public and private colleges and university in New York State. So that's, again, a New York State financial aid program. So I just thought it was important that people look at these things because what you don't know can really hurt you.
That's
correct?
right. Yep.
Yeah.
All right, let's go back to the phones and let's talk to let's see, who is on one? Do we know?
Dick.
Hey, Dick, I see. Hi, Dick. This is Esther. How can I help you, sir?
Yeah, I'd like to know how much of a gift could I give to my grandkids?
Well, you don't have to. You can give
$1,000 or something. Is that true?
No. Okay. So here's the thing. You can give as much as you want, up to like $5 million, and the estate exclusion. Actually, let's just say $1 million because we're on New York State gifting. Let's just say $1 million. You could gift it all at once, but you'd have to do a gift tax return next year to let the Internal Revenue Service in the state of New York know that you gifted away money. It's not going to cost you anything but the time to do the gift tax return. If you wanted to gift away your entire estate, you can. But if you don't want to do the gift tax return, then how much is he limited to, guys?
$14,000 a year per person.
Per person, per year. Right. So you could, if you have 10 grandkids, you could give each one of your grandkids, if you don't want to file the gift tax return, $14,000 this year, which would be $140,000 if you wanted to gift it away, and you don't have to do a gift tax return.
But I think, like Esther said, if you do a gift tax return, it's more of like a bookkeeping form to see if you're near that $5 million threshold.
Because one of the other proposals in the Trump tax agenda is that there would be no
estate
taxes. Now, the state of New York is never going to follow suit with that. So, but for the federal, there would be no. And again, it has to go to the Senate. So, but right now, if you have an estate that's, let's say, $700,000, and you want to give it all away tomorrow, you can do it. You can gift it all away tomorrow. That doesn't mean that the nursing home wouldn't look at it if you want to go on Medicaid. Okay, but it means that you do a gift tax return, but you're not going to pay any taxes on it. Okay?
Well, I'm thinking on that. I don't know where I got that number from, $14,000, but
it is 14. It's $14,000 per person per year.
Each two, and you don't do that without any tax liabilities.
And you don't have to file a gift tax.
There is
return.
no tax liability on a gift, Dick.
What, the $14,000 is the number?
14 is the magic number.
Is the magic number to file a gift tax return.
Right, but there's going to be no deductibility on your end, no taxes on your end, and no taxes to the recipient.
Do I have to keep some kind of record of that for the Internal Revenue Service?
You know, it's always a good thing to keep a record of anything because in the event that you have an untimely death, you wouldn't want somebody to say, wow, he gave away $100,000. Did he comply to the $14,000 per person per year requirements, or because he didn't do a gift tax return? So it's always good. Records are always a wonderful thing to have.
Yeah.
Okay?
Yeah, I appreciate you.
Thanks, Dick. Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930. And during the week, we're at our corporate office at 632-7886. Let's go quickly to Jeff on 2.
Hey, Jeff.
Hi, Esther.
Hey.
Thanks for taking my call. I'd just like to say I appreciate this program. Listen fairly regularly. It's very interesting and entertaining.
Entertaining?
Ooh.
All them numbers are entertaining. We hope that they are. You know, it's tough to talk about numbers. I mean, it's pretty boring to talk about numbers.
Kind of guy. Anyway, my question is, I'm going to retire in 2017. In 2018, I expect to get some residual bonus income from my employer, and also some income from non-qualified stock options and a payout from a non-qualified pension plan.
Okay.
My question is all of that money considered earned income?
Okay, well, the non-qualified pension plan is anything that's in a pension plan, even if it's non-qualified, is going to be considered a pension. Your bonus is going to be considered wages.
Okay, so I guess I'm thinking that my pension would be taxable income anyway.
Yeah, it's all taxable. It's the way that it's taxed. So your pension, your non-qualified pension is taxed.
I'd like to take Social Security benefits next year. Will my Social Security payments be?
Now, how old are you?
I will be 63.
Okay, so until you're 60, till your normal retirement age, then you're limited to that 17,000. And this is what I'd suggest you do: talk to your HR department and ask them, do they consider the non-qualified money? Are they going to pay you on a W-2 or a 1099-R? If it's on a 1099-R, then it's not going to be considered wages. If they're paying you on a W-2, then it will be wages.
I was thinking he could put money in an IRA in 2018, too, for that pay he's getting.
Right. But you know what I'd suggest you do, Jeff? Give us a call, and maybe we could do a 3-way and call your HR department and find out exactly, okay?
Okay, so I think it's pretty simple. If it's W-2, it's income.
Right. W-2, it's going to be restricted as far as gross income, $17,000. If it's on a 1099-R, you're good to go. Okay?
Yep.
I'm Esther Golias, the tax lady from EG Tax. Thanks for listening. We'll see you next Saturday. Have a great week. Bye-bye.